All right, with that, let's get into the week. And this week, we're going to focus on vegetable oils. Obviously, the big news today is the reports that Russian troops are moving back from the border of Ukraine. That has sent energy prices sharply lower and has triggered broad selling across commodities. So the soybean complex is also lower. Soybean oil prices were down about a penny. They've paired those losses and they're down about 40 cents right now. While the tensions in Ukraine drove energy prices sharply higher in a relatively short period of time, I think the outlook for energy kind of remains unchanged. Obviously, I think it's probably not quite as bullish as it would have been had Russia invaded Ukraine, and I suppose there's still some chance that they might do that. But it still seems like demand is probably stronger than supply. And so the setback in energy prices, while we've kind of built it into our forecasts, is something that could be reversed in pretty short order. And we could be looking at higher energy prices. Beyond that, our thinking around the soybean oil price really hasn't changed, and we expect the expansion in renewable diesel capacity to pressure feedstock prices higher as we move through the year. You add on to that the shortfall in the crop in South America, which conditions down there have maybe improved a little bit, or I guess maybe the best thing you can say is that they haven't deteriorated more. And so the way that that's really going to impact soybean oil prices is that it is going to mean that Brazilian soybean exports to China aren't as strong as they might otherwise be. And that sets up a situation where later this summer you'll have US exports to China probably stronger than they have been the last couple of years. And that will limit the supplies that are available for crushing. In addition, it sets up a situation where if US farmers don't expand acreage by at least 1 million acres, we will take soybean stocks down to sort of pipeline levels, and that will obviously drive soybean oil and feedstock prices higher. There is a scenario where you can say that world soybean exports are about 5 million tons short of demand. And in that situation, then US farmers would need to expand acres by more than 5 million, or soybean area by more than 5 million acres. And that seems like something that's very unlikely to happen. Fertilizer prices have gone up. And so typically you would expect that farmers would shift from corn to soybeans to reduce their risk, because corn uses more fertilizer than soybeans. But we've had some conversations with big farmers, and they haven't indicated a willingness to plant a lot more soybean acres this year, which is kind of surprising. And there is still time for them to change their minds. Next month, at the end of next month, on March 31st, USDA will release its prospective plantings report. That report generally generates the most volatility, or at least is one of the more volatile trading days of the year, because it's our first look at what the supply for the next year might look like. This year, it's probably, the volatility is probably likely to be heightened because of that situation. And so farmers may change their minds and report something to USDA, and that would come out on March 31st. But they typically order their seed and their fertilizer for the following year at the end of the last year, in sort of December of 2021 for the 2022 growing season. So they've kind of already probably put into motion some plans based on whatever decisions they've made. And so it seems unlikely that this is going to change. And in that extreme scenario, and I've got to sort of highlight the fact that I think that's an extreme scenario. I don't think it's a high probability, but it's worth mentioning because in that scenario, I think that soybean prices could top $20 a bushel, and that would obviously imply soybean oil and feedstock prices rising to record levels. Now, I think that the reason that scenario is relatively low probability is because I think that as prices rise, China will probably back off their imports a little bit. That said, I think what that scenario sets up, and the reason that it makes me believe that prices could rise to really unprecedented levels, is that if we're 5 million tons short of soybean exports for the world, then you basically are in a situation where prices need to go to a level where they ration demand. And if you think about the two competing camps for soybean demand at that point, they are China and the US biofuel industry. China's demand is terribly inelastic because they've lived through famines and they're very sensitive about food security. They also have built their hog herd back from the outbreak of African swine fever, ASF, and in doing that, they modernized their industry. So they went from an industry that had sort of a couple farmers, or had farmers feeding a couple pigs in their backyards, to large industrialized farms that look much more like US farms than they do like old Chinese farms. The big difference there is that on a per pig basis, those hogs eat a lot more soybean meal than they do if it's just 3 pigs in the backyard. If it's 3 pigs in the backyard, you tend to feed them table scraps and kind of whatever's around. If you're a big industrialized farm, you feed them a professionally made feed mix that includes a lot of soybean meal. So they built their hog herd back up, and on a per hog basis, they're feeding more soybean meal. That means that their demand is much more inelastic than it has been in recent years, than 5 years ago for sure. On the other side, you've got the US biofuel industry that obviously is guided by the RFS mandates. And so they have to secure enough feedstocks to meet those mandates. And as a result, their demand is also very, very inelastic. Getting either side to ration demand is going to be terribly difficult. And that's why I say in this extreme scenario that prices could rise to levels that we just haven't seen. And honestly, it's very hard to kind of predict prices in a scenario like that. I was talking to somebody and they said, okay, so what would be the price where at what price would soybeans start to ration this demand? And it's really tough to tell. So you just pick a big number that you think makes sense, but it could be off by quite a bit, to be really honest about it. I picked $20 because it's kind of a round number. It's also well above the highs that we saw in 2012, but it could be that 18.50 gets the job done, or it could be that $22 gets the job done. It's just almost impossible to make a good guess at where the price can go once you get above the old highs. Either way, it's harder to construct a scenario where soybean oil or feedstock prices move substantially lower ahead of the US harvest. Now, if we do get a big increase in soybean acres and US growing weather support sort of trendline yields, we don't have a drought in the northern plains or in the Canadian prairies, so the canola crops come back, then I think that you could pressure prices then. And that's kind of what our forecast is built around right now. That's why we have the decline in prices starting in sort of July. The sort of typical seasonal pattern would be that the market would add in weather premium into sort of June, July, and then at that point the market has a pretty good sense of what the weather outlook is for the U.S. and what yields will be, and it starts to take weather premium out. So our current forecast is sort of based on that idea that we do get enough of an expansion in acres that we can meet whatever shortfall in export demand out of South America there is, and still fill the needs of the biofuel industry. We'll see where that is, and we'll have a much better sense of what we think the second half of the year looks like after we get this March 31st report. And so you may see a big change in our forecast outlook after that. Between now and then, again, I think that that the expansion in renewable diesel capacity combined with what are still relatively bullish world fundamentals will continue to support soybean oil prices, even if we do have this setback in the short term because energy prices fall following the reduction in tensions in the Ukraine. There's not much new fundamental news over the past week. The one thing that we did get was the NOPA crush report that just came out. I really haven't had a lot of time to look at it beyond just to be able to say that crush came out below market expectations, but it looked like it still was fairly high, and that kind of supports USDA's move in their most recent WASDE report to increase crush, and it supports our crush forecast, which is still just a little bit above where USDA is. You can see USDA raised their, this is soybean oil, sorry. USDA raised their crush forecast to, I think, 2.15 or 2.215 billion bushels, which is like 10 million below where we are. We're at 2.225. Even though crush was below market expectations, I think it still looks like it was relatively high and would sort of support that level of marketing year forecast. So the next thing that we'll really get in terms of new fundamental news for the soybean oil market is the March 1st fats and oils report, and that'll give us more insight into what the supply and the demand was for soybean oil in January. Similarly with canola oil, not a lot of changes. In last week's USDA report, they didn't really make any changes from their January report, and this table hasn't updated. I apologize for that. They didn't make any changes to their US or Canadian balance sheets. There is a report that comes out in the second half of March, typically, that is the oil crops yearbook, and there's a data set that comes out with that includes historical supply and demand data for canola and canola oil. So typically in February, they don't make very many changes, and then they make some changes in March, and those are reflected in the oil crops yearbook. So not a big surprise that they didn't make any big changes to their forecast in this past month. In palm oil, it continues to remain at record levels. We expect that because of the flooding in January, that may set the seasonal low in production, at the very least from a sort of average daily production perspective. And we expect that as production rises, that probably will kind of pressure prices a little bit going forward. However, the big question is they're just kind of getting the Omicron wave in Malaysia right now. And what we've seen in past waves is that the Malaysian government has instituted lockdowns that have reduced the capacity of plantations to maybe 50% or 75% of what they normally might be able to do. The Omicron wave tends to be really, really strong going up and then really, really fast coming down. And the disease doesn't seem to be as severe as even the Delta wave. And so maybe the Malaysian government will hold off on lockdowns. But if they don't, then that's going to restrict production in February, and then prices probably are going to stay closer to record levels for longer than we expect. Now, there's another thing at play here, which is kind of the fact that over the past several years, the Malaysian tree inventory has gotten older. It hasn't been replaced at the same rate that we've seen historically. And so as the trees age, they tend to lose productivity. That's also contributing to the larger than usual shortfall in production during this seasonal decline. That's something that in the longer term probably will support higher Malaysian palm oil prices, but it may also impact this turn that we expect in production over the next month or two. Certainly over the next month or two, it's going to turn. By the time we get to March, I think we're going to be through the seasonal low and we're going to see output increasing, and that's going to pressure prices. This is really important for the soybean oil market and the feedstock market more broadly, because palm oil and soybean oil kind of compete in the world for exports. And we've seen the spread between soybean oil and palm oil fall from a high of like 30 cents last summer, which, to be fair, was an historic high and well above what we'd seen before. But it's fallen down to around 2 cents, which is which really provides an economic incentive for countries to switch from palm oil to soybean oil for exports. U.S. exports have been stronger this year than we anticipated early in the year, and as a result, we've raised our export forecast by 350 million pounds, from $1 billion to 1.35 billion. But we haven't raised it further because we expect that at some point the growth in domestic demand is just going to shut exports off. The reason that the recovery in palm oil is important for U.S. soybean oil prices is because if that doesn't occur, if the seasonal turn is shallower than it typically is, then there's going to be more demand for U.S. soybean oil exports. Now, I'm not trying to argue that I think that ultimately we're going to have 2 billion pounds of U.S. soybean oil exports just because there isn't enough room in the balance sheet to do that. But we could have incrementally more exports than we're expecting right now, and that would cause significant upward pressure on prices, again, given the inelasticity of demand from the U.S. biofuel industry. The other reason that Malaysian palm oil production has been lower than normal during this seasonal downturn is because of the pandemic, and the fact that it's been really tough to get migrant workers into Malaysia to help harvest the palm. The Omicron wave isn't going to do anything to make that easier, even if the government doesn't decide to impose new lockdowns. And so maybe this turn just doesn't come out quite as quickly as we're anticipating. And in that case, again, it would support higher palm oil prices and a narrower spread to soybean oil. And again, we get back to potentially more U.S. soybean oil exports than we're expecting right now. A good way to monitor that whole situation beyond sort of paying really close attention to the Malaysian palm oil market is just to look at the US Gulf basis. Now, it hasn't been particularly strong recently. I mean, it's been relatively high, but it hasn't been as strong as we saw it sort of last year when we really did shut off exports out of the US. So there's room for that to move up. And I think you can assume that if palm oil production is lower than expected, that US Gulf basis probably will increase in the coming weeks and months. Eventually, palm oil production will recover to normal levels, or at least closer to normal levels, and we're expecting a year-over-year increase in palm oil production. And so at that point, that will ease the pressure on US exports, and then obviously that basis level would fall. All right, on to biomass-based diesel. So, excuse me. This week, we're going to get the monthly EPA data for biofuel production. And historically, what you see in January is a sharp decline from December. And that's because there's a couple of reasons. One, demand is slightly lower in January, but probably more important is that in December, typically you see obligated parties sort of scrambling around to get enough RINs to meet their RVOs. And so production goes up quite a bit in order to ensure that there's enough RINs available for everybody to meet their individual RVOs. And then in January, you've got a whole year to meet your RVOs. And so production tends to fall off. Over the last couple of years, that impact hasn't been as great because we haven't known what the mandates were, but now we do know what the mandates are. And so we did see a big increase in production in November and December in particular. And now we expect the typical seasonal decline in production in January. Whether production falls as much as we expected or it remains to be seen, but the level of production in January, I think, will tell us a lot about what's going on for the rest of the year. And so we have both renewable diesel and biodiesel production falling pretty sharply. And we're predicting renewable diesel production is almost cut in half in January. That might be a little bit pessimistic. And if it doesn't fall that much, or it kind of holds steady, it was 110 million gallons in December. If it's 95 million gallons or 100 million gallons, that's going to tell me something about what production is going to be on a monthly basis going forward. And we probably would end up raising our forecast for the entire year. There remains this idea that there's a significant gap between the ethanol mandate and the actual ethanol demand. And you can make that gap pretty big. I think you could relatively reasonably argue that gap could be as big as 750 or 900 million gallons. But we're assuming that gap is probably 400 million gallons. If January production comes in around where we expect, then I think everything is in our forecast is going to be okay, and we're probably going to leave it unchanged, at least until we get the next set of EMTS data. However, if it does come in above our expectations, I think one of the reasons will be is because that gap may be a little bit bigger than we expect. Now, when we adjust that gap, we're probably going to favor increasing biodiesel production over renewable diesel production, primarily because we have a pretty sharp drawdown in biodiesel production built into our forecast for this year. We're expecting biodiesel production to fall from like 1.7 billion pounds last year to like 1.35 billion pounds this year, or gallons this year. And so if that gap is a little bit bigger than we expected, or a lot bigger than we expect, we probably will add most of any increase in our expectations for that gap to biodiesel production, because we assume that the rationalization of the biodiesel capacity will probably be a little bit slower than we are expecting. We think that renewable diesel production is kind of going to be what renewable diesel production is going to be. The question is more about whether it follows this sort of typical seasonal pattern or it's a little bit flatter. And so the January data will give us some indication of what we think the shape of the month-to-month production is for renewable diesel, but it'll also give us some indication of what we think that gap is and how much we may need to raise our biodiesel forecast. All right, beyond that, if we look at gross margins, there was an increase in the gross margin for biodiesel this week. I still don't know why this chart doesn't show the numbers that I see in my spreadsheet. Anyway, we think that biodiesel margins with credits profitability jumped to 16 cents this week, up from I think it was 2 cents last week. And that was primarily because there was a decrease in soybean oil prices and an increase in biodiesel prices in California. Conversely, and that was the highest profitability estimate we've had since April. Conversely, on the renewable diesel side, we saw margins contract a little bit. That was due in part to an increase in most of the feedstocks that we use in our feedstock mix assumption. Prices went up a little bit, and a decrease in renewable diesel prices in California. We still expect that increasing renewable diesel capacity will pressure margins over the next year, over most of the next year. But again, that's based on right now this idea that energy prices may have peaked in the short term and start to come down. In the extreme, I think you get the situation where energy prices come down and you have the situation in soybeans where they go to these historic levels, and soybean oil prices go to these historic levels, and that'll really pressure margins. If we get that situation and the gap between ethanol production and ethanol in the ethanol mandate is larger than we expect, it could be really interesting. And I think that in that case, you probably see RIN prices rise up to record levels and probably well above what we saw last year, as they're required or forced to do so to offset the increase in feedstock prices that isn't matched by a similar increase in fuel prices. But either way, our base case is kind of that pressure on margins through the rest of the year rationalizes biodiesel capacity as renewable diesel capacity expands. Our RIN forecast hasn't really changed that much from last week. We're still expecting RIN prices to rise along with the increase in feedstock prices. We still haven't really narrowed that spread in our forecast between D4 and D6 RIN prices that much. Again, the January data, I think, from the EMTS will give us some insight into where we're headed with ethanol production and what that gap might look like. And so I would expect that by the time we get together in March, I'll have a better idea about where I think that gap may narrow. And our forecast may look a little bit different. The D6 may move a little bit closer to D4, and both of them may move a little bit higher. But for the moment, we're still kind of going with it's not quite as wide as I think the model would like it to be, but it's not as narrow as I think I would pick if I were just kind of doing this by hand. I think I would probably make the gap a little bit narrower here. In terms of the outright price level, I think that that given our outlook for feedstock prices, I think the outright price level makes sense. It just may be that D6 is closer. And of course, if D6 moves closer to D4, that tends to drive D4 prices even higher. So if we do narrow that gap, it probably would also include an increase in the outright price forecast as well. And finally, LCFS credit prices, still the same, haven't changed this forecast. LCFS credit prices remain sort of stable around $150 per metric ton. And we still expect them to come under pressure as renewable diesel capacity expands. All right, with that, I have gone over my 30 minutes. Does anybody have any questions? If you do, pop them in the chat or in the Q&A part. And if not, oh, somebody does. For the SBO futures forecast on the website, why are not futures prices for, why aren't there futures prices for February, April, June, and November? It's because there aren't futures contracts there. So if you look at, where did it go? If you look at, sorry, this isn't showing me the right window. If you look at the price forecast, okay, if you look at the price forecast, the reason that we go from May to July is because if you look at the futures curve, there's a May contract and then a July contract. And so what we're actually predicting here is the average futures price during the time that it's the nearby contract. And so what that means is that for the current nearby contract, which is the March contract, what we're trying to predict is the average price in from January through February. So the average of the January and February prices, because there's a January contract. And so when that we roll the contracts on the first of the month of the contract month, and we try and predict the price for the period during which that contract is the nearby period. That's a little, I didn't do a very good job of explaining that. But essentially, as each contract rolls off, then we roll to the next contract, and there are gaps in between contract months. There are not contracts for every month for soybean oil. If you look at palm oil, there essentially are contracts for, well, there are contracts for every month. And so for palm oil, what we're trying to predict is just the price of the contract during the period which it's the nearby contract, which is just 1 month. So for the March contract, what we're trying to do is predict the average price in February. If you think about that in soybean oil terms, there's a January contract and then there's a March contract. So for the March contract, we're trying to predict the average price in January and February, when that March contract is the closest contract, which also tends to have the most trading volume. And so it's the most liquid and probably the most reflective of soybean oil prices at that point in time. Can you run through your assumptions as to why biodiesel production is down year over year? How much is assumed plant shutdowns on negative economics? So our assumption is really there are two things driving the assumption of this sharp decline in both biodiesel and and renewable diesel production in January. Or there are a couple of things really. Not much of it is really due to plant economics. Plant economics are something that we monitor, and at some point they're going to be something that are much more involved in our forecasts than they are right now, quite frankly. Right now, there are some times where traditionally plants take maintenance breaks, and we incorporate that into our forecast. But what we don't necessarily do is take our margin projections and then translate those directly into production forecasts. The way that we really do it is we look at what we think the annual production number is going to be, and then we kind of use the seasonal pattern historically to spread that annual forecast out into each month. And so based on that, what typically happens in January is you get a big decrease in production from December. And there's really two reasons for that big decrease in production. The first is that during the winter, demand for biodiesel is a little bit lower. It used to be significantly lower because the cloud point for biodiesel was such that you had some real problems if you tried to use it in really cold weather. It would turn into a gel essentially. They've made some improvements in that area, and so that's a little bit less of a concern, but it still has some impact on biomass-based diesel demand during the winter months. Beyond that, there's a little bit less driving during the winter. Obviously, for big trucks and stuff, those guys are going pretty much no matter what the season is, but there still is a little bit of interruption or just a little bit less driving in January than there is during the summer months, when typically the weather is not a problem anywhere across the country. The other thing is that individual blenders have renewable volume obligations. And so those volume obligations are on a calendar year basis. And at the end of the calendar year, they need to make sure that they have enough supply, enough RINs to meet their RVOs, their individual renewable volume obligations. And so in part, they kind of tend to make sure they kind of increase production to ensure that that they're going to meet those obligations by the end of the year. And so you get this seasonal pattern where you get big increases in the fall towards the end of the year. And then at the beginning of the year, because there's no pressure to meet RVOs, then you don't have that same impact on the demand side, I suppose. And in addition, maybe you produced a little bit too much in December and you don't need quite as much in January. So there's a very strong seasonal pattern there from December to January. Now, over the last couple of years, that pattern hasn't been as strong because nobody really knew what the mandates were. And so while there was still some increase in December and then a fall off in January, you can see it here in biodiesel production more than you can see it in renewable diesel production. It wasn't as pronounced as it has been. I think the question for this year is renewable diesel, there's two really. Is renewable diesel production going to fall and follow the typical pattern that we see in biodiesel? Or is it going to be, if you look at ethanol production is pretty steady year round. Or will it be more like ethanol production? This is the first year what we really have is this big increase and are expecting a bigger increase in renewable diesel capacity. And so this production in January, I think, will tell me a lot about whether that pattern will continue, or we're going to, whether we get that typical seasonal pattern or we get sort of just steady production month after month after month. For biodiesel, because we now have the mandates, I would expect that we would get the typical seasonal pattern with a big drawdown in production in January. However, because of this gap between ethanol mandates and ethanol demand, if you look at US gasoline consumption, we typically blend between 10.2 and 10.5% of the total gasoline consumption with ethanol. That implies a shortfall in ethanol production of about 400 million gallons to the mandate, and that needs to be made up by D4 production, essentially, which is mostly biodiesel and renewable diesel. Given that our renewable diesel forecast is mostly set around the expansion of capacity and what we think capacity utilization is going to be throughout the year, that leaves any increase in D4 production due to that gap being bigger than we expect to fall to biodiesel. And because we've cut the biodiesel, our forecast for biodiesel production pretty sharply, what we'll end up doing is looking at this January data as an indication of what that gap is, and then adjust our annual biodiesel production forecast based on changes in that gap, essentially. In the extreme, if that gap is a lot bigger than we expect, what we would think is that will slow the rationalization of biodiesel capacity, and so it will raise our annual forecast for biodiesel production. We'll still have some seasonality built in there, and there will still be some times when sort of the industry typically takes maintenance breaks built into the forecast, but the whole thing will probably shift up a little bit. I hope that answered that question. If not, please feel free to reach out, send me an email, and we can talk a little bit more about it. All right, everybody have a great week and a great next week. I will see you back here on March 1st, and enjoy your long weekend. Hopefully you get a long weekend this weekend. Enjoy your long weekend if you do. All right, goodbye. Thanks for attending.